everyone. I'm Virginie Menison. I'll soon complete the Warwick Business School MSc Global Central Banking and Financial Regulation. I'm delighted to be joined here today by Paul Fisher and Jarmid Murphy. So Paul is honorary professor at WBS. He previously worked for a number of years at the Bank of England, and that included a stint on the Monetary Policy Committee. Jarmid is on secondment from the Central Bank of Ireland to the European Commission, where he specializes in sustainability issues. So his career also includes time working at the IMF and the European Central Bank. So you both lead the Comparative Central Banking module at the Bank of England. So first, Jarmid, why should central bankers study this module? And what can they bring back to their actual institutions when they finish?
Thanks, Virginie, and delighted to be here with you both today. In answering your question, I see two main benefits for central bankers or those working in financial authorities who undertake the Comparative Central Bank module. The first, I think, is that central bankers often face a challenge. Like, they're generally well versed in their own roles, but they may not be so familiar with what's happening in the division around them or the directorate next door, or even with those of other domestic financial authorities. There's sometimes maybe a little bit of limited knowledge of how their respective areas intersect and contribute to the central bank's overarching goals and objectives, or even contribute to the policy objectives of other domestic financial authorities. Paul and I are seasoned central bankers. We bring our practical experience to the module from our time with our respective central banks and our international work, including with many global central banks. So we therefore look at the issues through a horizontal lens. And maybe I can give an example in terms of climate and environmental risks. This has relevance for firm-level supervision, macroprudential and financial stability analysis, relevance for implementation of monetary policy, the instruments, the tools, central bank investments, even the creation, transportation, destruction of banknotes, resolution of firms, and of course the conduct of firms. The topic of non-banks is a similar example, which involves considerations related to market functioning, liquidity operations, stability, crisis management, even central bank communication. Therefore, we don't approach these topics from a standalone perspective, but rather through the lens of their relevance to all mandates of a central bank. The second benefit I see is that by comparing and contrasting the roles and responsibilities of global central banks and country authorities, the module provides central bankers with an opportunity to reflect on the institutional or framework elements related to their own role. These elements can often be taken for granted, prompting the question of, actually, why do we do things that way? We aim for the module to be interactive, with the topics covered generating a good discussion amongst the students. And we hear from students that they do bring the learnings back to their own roles within their respective central banks or domestic financial authorities.
Yes, I can really relate to that. And Paul, it's not only just for central bankers. What can people working in the financial sector, like banks or insurers, actually gain from attending the module? And what can they take back to their own institutions?
Well, thank you, Virginie. I very much agree with Dermot on the central banking and financial regulator aspects. But actually, everything that happens in central banks and financial regulators has a huge impact on the whole of financial markets these days. Obviously, through setting monetary policy or financial stability changes, that can directly affect the prices of financial assets. But these days, even just a speech by a senior central banker can have a massive impact on financial markets by changing people's outlook on the future. And if you're working anywhere in financial markets, from an asset manager through a rating agency to an investment bank, you need to understand what central bankers are doing and how that's impacting on the work you're doing. And at any one time, up to about half of our students can be not from central banks, but just from people working often in the City of London, but actually anywhere else in the world as well. And we do have students from all around the world. And we focus very much on what's happening in every corner of the globe, not just what's happening in London. And financial regulations are sometimes located in the central bank, sometimes not. And we reflect those differences in our course. But if you're working in any sort of authorized institution, impact of financial regulation is again pervasive, and investment banks, commercial banks, insurers spend a large amount of money and have a lot of staff working on financial regulation and to make sure that they are consistent with it and aren't going to be held to account for failures against the financial rules. So whether it's a carrot or stick, there are certainly very good reasons for all financial market participants to understand how the authorities think, how they're going about their business, not just what the rules are, but how they might change in future, how they're being implemented and designed.
No, I can really relate to that. And I must admit, I really enjoyed, having a very varied cohort to exchange views with. But now, Paul, again to you, is there a particular monetary policy issue you think that central bankers might reconsider or have learned lessons from? And, what would that mean in terms of future policy stance?
Oh, when we first developed the course, we were focused very much on lessons from the great financial crisis in 2007-9. But of course, since then, we've had the COVID pandemic, and that impacted hugely on central banks and regulators. And more recently still, the surge in inflation globally. And wherever you look, the US, the EU, the UK, Australia, in many countries, inflation surged to levels which we haven't seen for 30 odd years. And this is the biggest test, I think, for inflation targeting since it was first introduced in the early 90s. And the inflation wasn't expected by central banks. Arguably, they were a bit slow to react with interest rates. They thought it was going to be more temporary. They didn't forecast it well. They have now got on top of it, but it's been quite expensive to get inflation down again. And central banks will have to look back on this episode and really try to take the lessons out of what happened. Why did it take them by surprise? Why didn't they recognize the signs earlier? Because what we've learned as a society, again, is just how rotten it is to have high variable rates of inflation, how bad it affects society, the political cost. Particularly, it impacts on the poorest people in society. Those on fixed incomes or low incomes suffer most from inflation. So there, I think, a very healthy dose of self-reflection going on across the central banking community. And in the Bank of England, for example, they're having a review of their forecasting models by Ben Bernanke. But I think the problems go a lot wider than that.
Oh, that's really interesting, Paul. Jarmid, I'm quite curious to hear your take on the same question. And particularly, what does this mean for emerging countries and their own policy stance?
Yeah, maybe let me come at that question, maybe from a more operational perspective, if I could put it that way, and maybe from the perspective in terms of the challenges it has created for developing country central banks, which have faced a number of challenges in recent years. I guess traditionally, for many emerging economies, managing system-wide liquidity within a structural liquidity surplus environment, and that's attributable to commodity-related flows, low government debt financing, etc., has been their key task. However, a global tightening of monetary policy and the consequent rise in interest rates has necessitated a shift towards more active liquidity management by these country central banks. This process has involved employing instruments to absorb structural excess liquidity within the system, reintroducing, or even in some cases swiftly introducing, liquidity providing instruments to meet the liquidity demands of the system at the margin. It also includes preparing for and clarifying the financial safety nets, which encompass emergency liquidity measures, establishing a clearly defined resolution framework, for example, for the quick and safe resolution of problem firms. But the task was further complicated by the fact that commodity exporting countries experience volatility in foreign exchange receipts, which impacts the level of domestic currency in the system, as commodities like oil or etc. are traded in dollars and not in the local currency of the producer. And there's also often an uneven distribution of liquidity within the local markets. Consequently, these central banks typically find themselves managing two markets, managing the liquidity position of the larger banks that possess liquidity buffers, and the smaller banks then that have limited or no access to interbank or wholesale markets. But we delve into these operational challenges and issues in more depth through our comparative central banking module.
No, that's true. I really recall going through these kind of questions. But can you also, Jarmid, maybe give us an example of a particular policy development or an innovation that you've seen coming from emerging countries?
Yeah, for me, I think emerging economies or emerging economy central banks, I should say, are at the forefront of numerous innovative policy developments and technological advancements in central banking. What comes to mind is central bank digital currencies, machine learning, data analytics, and financial inclusion technologies. Currently, central bank digital currencies, CBDCs, are generating significant interest. And I'm aware of some developing countries that are making considerable progress in terms of the design and implementation of CBDCs. But CBDCs, I think, offer considerable benefits for developing countries and even in some cases, potentially more than for developed countries. For instance, CBDCs provide financial inclusion benefits for those who either lack a bank account or prefer just not to have one. CBDCs also reduce the need for central banks to order physical cash, which can take weeks to mint and deliver. And actually, there may no longer be a demand by the time the currency does arrive. Additionally, transporting cash carries security risks, particularly for countries covering vast areas or even comprising numerous islands. So in our comparative central bank module, we also discuss some of the key design considerations, including any potential reduced role for the banking system, the operational IT risks associated with CBDCs at a high level, but also the risks to the stability of the domestic currency. And moreover, we examine these considerations and I think just more the evolution of CBDCs more generally in our module.
Well, thank you both. I've really, really enjoyed this conversation and I hope our viewers will too. And I hope to see you soon.
Thank you very much.
Thank you.